Have the wealthy stopped spending? We have heard for several years, obviously, that with the increase in inflation, the folks kind of below the 50% line have been struggling. But now we are starting to see signs of the wealthy, the top 20, top 30% start to pull back. This is something we have to watch because, again, I don't think it's a secret that the top 30% have been leading with purchases, and they're the ones with the discretionary income. I noted a couple of different things in articles over the last 24 hours. First, an article from Vantage Score talks about delinquency rates for borrowers with incomes over $150,000 are near the highest in 5 years. Is this job layoffs? Is this too much debt? Don't know, but it is something certainly to watch for. In the same article from Vantage Score, they talked about credit utilization dropping in December. Obviously, credit utilization, if you don't know what that means, is, hey, you have, a $50,000 credit line, and credit utilization means you are using less and less of that. Is that credit utilization a sign of stress? Is it a sign of fear? Is it a sign of, hey, we're just going to go pay off debt? Don't know, but it's something to watch. Probably the most important thing from that Vantage Score article was the fact that high earners' intent to spend decreased in January. Now, intent to spend is a very interesting metric because you may intend not to eat that cookie and then you eat that cookie. In fact, you might eat 2 cookies. So intent to spend is a very, non-scientific kind of a feeling based. And again, not intent to spend can change very quickly. So I've done some further digging into areas that are kind of negative and positive. So there was an article by the Las Vegas, I forget the newspaper, Las Vegas Journal, I think it is, talking about Vegas casinos posting 5 consecutive months of year-on-year declines in gaming revenue. Now, what does that tell you? Hopefully it tells us we're less gambling addicts, but that's probably not true. Just the fact is, not as many people are going to Vegas in gambling. Now, in fairness, when you look at this picture, could Atlantic City, could Macau, could other gambling meccas be growing and Vegas losing? Absolutely. Certainly could be that. Maybe the folks from China are going to Macau instead of Vegas. Certainly possible. But 5 consecutive months of decline is interesting. It's something to look at. Now let's flip the script. I actually indicated this was an earnings report on Sunday that I was really interested in, and that was, of course, Royal Caribbean. If you don't know who Royal Caribbean is, it's kind of this umbrella brand of cruises. I think they have Princess and all these other cruise lines under it. Well, Royal Caribbean beat top line, beat bottom line, total passengers up 11.3% and passenger days up 8.5%. They beat and raised. So I think about that. Royal Caribbean doing really well. Royal Caribbean being a brand that boomers and likely older Gen X like. In fact, you know that Olivia and I frequently do cruises a couple a year. It's interesting. So we're not gambling as much, but we're going on more cruises. Probably a good thing, right? Instead of throwing money to the house in Vegas, you go on some trips, make some memories, have some experience. So again, it's really interesting to see what's going on with the folks at the upper end of the income and wealth scale. Since we're talking about earning, we might as well close out. There was 2 more. GM, General Motors, beat top line, beat bottom line. They actually did $47 billion in top line revenue, which I was frankly shocked by. Apparently, we are still buying very expensive trucks and SUVs. It's hard for me to imagine a recession when GM is selling this many cars. It's hard for me to think about. Then there's JetBlue, beat top line, beat bottom line, but interestingly enough, highlighted higher cost, aka expenses, and missed on revenue expectations. I didn't check this morning, but I'm guessing that combination is not good for JetBlue's stock. We also got some other economic data that we were following as we talked about on Sunday. First up, durable goods. Again, durable goods, if you don't recall, those are items that are expected to last 3 years or longer. Think refrigerator, washer, dryers, things of that nature. Last month, it was down 1.2%. Was expected to increase, or forecast was 0.6, was expected to turn positive. Well, it actually went negative, more negative. So a disappointment, came in at negative 2.2%. So again, certainly less than expectation, and actually got worse month on month. We did get Schiller's report. Again, to me, it's outdated. This is November data. It is not interesting today, but when we go back and look at historical charts, it will mean something. Again, just further evidence that the 2025 crash bros were wrong again. The 20 Metro Schiller came in at positive 4.33 for November of 2024. So certainly not a crash. One other economic data that came out was consumer confidence. It was last month 104.7. It was expected to improve to 105.9. It too also disappointed, like durable goods. It actually came in lower at 104.1. So did not get better, actually got worse. So some things to look at there. Do want to remind you that our event in Vegas is, we're going to stop selling tickets Friday. So again, if you want to get there, you've only got a couple more days. We did sell more tickets yesterday, so we're down to 31. One of those is a VIP, 30 general admission. If you have plans in coming, the event is 18 days away. You've got, 3 days to buy tickets. Get your tickets so that we can close it up Friday, and I will stop talking about it, which I'm sure plenty of you would appreciate, given it's been a daily talk for a month or so. We did get the CNBC did another Fed survey, right? Fed meeting starts today. Fed's in the quiet period. Fed will give us our announcements tomorrow. The Fed survey says they expect 2 cuts in 2025. 65% of those surveyed. That's actually down from 78%. So again, less and less confidence of 2 rate cuts. 61% thought we'd get 1 rate cut in 2026. That too is down. The last survey had that at 70%. Other things of note in the CNBC Fed survey, 55% of them believe deregulation will reduce inflation. Interesting. More than half thought deregulation would reduce inflation. That is a good thing. 68% of folks believe that deregulation will boost growth. So let me get this right. Less inflation, more growth. I don't know about you, but deregulation sounds like a good idea to me. Certainly if those things were come to bear. And then finally, probability of a recession in the next 12 months has collapsed to 23%, was 29%. Certainly in the first 6 months of the year, it's hard to imagine the economy, which seems to be growing at about 3% or so, entering a recession. It just frankly doesn't look possible given momentum. And yes, I know there are plenty of people calling for a recession out there, but I am no longer playing that game. I was wrong twice on recession calls, so not playing that game this year. We did get some housing data. Shout out Mike Simonson from Housing Wire, Altos Research. Looks like early numbers are asking price from listings is 421K. That's actually down under 1% from last year. Newly pendings, 384,000, actually up 2% year on year. Looks like there's 51,000 new listings. That is up year on year. Again, folks, we're starting to see rates matter, right? I've been telling you for a long time that 7% bad, 6% good. I've been telling you for a long time that inventory is going to build, days on market's going to build, transactions are going to fall. And you, yes, you, the person watching this is your time. This is a buyer's market. Buyer's markets don't come around all that often. Do the work, get a buy box, write disrespectful offers, follow up. It is a numbers game. Trust me, in your buy box, in your area, there is a motivated seller, at least one motivated seller waiting for you to find them. And here's the deal. They may not be motivated the first time you offer. They might not be motivated the second time you offer, but keep following up. Active listings are up 13% year on year. This is to be expected. Days on market will undoubtedly rise as well. There's currently 637,000 active listings. This, of course, is single family homes only. And then home sales are underperforming in 2024. For example, Mike highlights there's been 52,000 pendings this year so far. Last year, we had 56,000. Again, remember, folks, who brought you the call of sub 4 million transactions in 2025? This guy. So just gonna watch that roll through and see if we are right. Tom Lee, of course, is out talking all over CNBC yesterday, talking about the market sell-off from yesterday was an overreaction. It's probably not shocking that I'm guessing there would be some bounce today. NVIDIA lost almost $600 billion in market cap in one day. That was the largest loss ever. NVIDIA suffered a 17% plunge in a single day. I really do think there's a lot of questions. I saw an article about Meta having 4 war rooms spun up in 24 hours, trying to figure out what is real, what is not real. Is there a way to maybe reduce the horsepower required to run Llama or whatever their AI model is? This is exactly what you would expect to happen in the Valley. If there's 4 groups at Meta, there's probably 10 groups at Google. And, I would expect every tech company to be playing with understanding, trying to figure out if it's real or fake news. Got to remember there's still a lot of lack of trust with what's being reported. So you are going to expect a lot of research going on. David Sachs, obviously the crypto and AI czar. I didn't know we had czars. I thought czars were a Russian thing, but hey, whatever. David Sachs, the AI czar, said that DeepSeek's model shows that the AI race will be very competitive. This is very much like if you are a baby boomer, Russia's Sputnik moment. If you don't know what Sputnik is, give it a look. Sputnik moment, where Russia had something orbit the Earth. Actually, I believe sent a dog up there, if memory serves. And it really caused JFK to come out and declare that the U.S. would be on the moon within a decade, I believe was the call. So again, this DeepSeek moment will be looked at as an inflection point. And it will be very interesting to see where we go from here. Most interesting to me is we obviously have a bunch of tech earnings this week. I wonder how many questions they are going to get about capital expenditures. Think about it. Didn't Meta just put something out saying they want to deploy $60 billion? What if, just what if for a moment, most of what DeepSeek put out there is real? If you were a shareholder of Meta or Facebook, and there was a proven way to get better results with 95% less horsepower, would you approve a $60 billion capital outlay? Or might you reduce that? I expect lots of questions. I don't actually expect a lot of answers, but I do expect a lot of questions. Folks, I hope to see you in Vegas. We are 18 days away, 31 tickets. Don't forget to join school. We will obviously let the virtual session run. If you can't make it to Vegas, $99 gets you access to a Zoom, and you will get the replay if you can't watch the 2 full days. So I hope you're having an amazing day. If you are still watching this, do me a favor, hit that subscribe button, leave some comments. Let's get the YouTube algorithm actually working for one rental at a time. I would greatly appreciate it. Make sure you smile. Just have a good day. All right, everybody, take care. Later.